Hi guys, welcome back. It's another Thursday night. Time flies, time really flies. And yeah, let's wait for the crowd to come in. This company is one of the most highly requested by the public. Well, the company share price has been going up for quite some time. And yeah, people are maybe having the FOMO wipes whether this company still can buy or not. But as always at KayaPlus, we are not towards the direction that whether you should buy or sell this company or not, but rather let's go deeper into what the company does. And then hopefully by showing you guys, then you guys have a rough estimation or understanding of how the company runs its business, what are the risks, what are the prospects. And yeah, if it's your cup of tea, further do your due diligence and then yeah, you can buy. And if this company is not your cup of tea, you can also maybe get a little bit of lesson on how are the companies running a business, and just keep in mind that this company is not a cup of tea, and what are the other related companies that you should not also buy if their business model is similar to JFTech, Berhad. But yeah, maybe Chubeng, are you familiar with this company prior to the readers and also the viewers of KayaPlus TV, Not Solid Night Show?
I think this company, if you are following the stock market lately, you will know they are one of the few stock that performed quite well during this pandemic. And when you think of them, you will think of FP Group, which is also doing similar kind of things. And both of them also come up with quite a good result. And then it was in the headline or something, people, as in the trade volume suddenly goes up because of the quarter result and whatnot. So I think this is the reason why a lot of people trying to understand what actually is their business model, what is the thing that they sell, what is the product, and how come they can make quite a lucrative returns during this pandemic.
All right, cool. So yeah, I think this company, if you look back, back at the lowest in March during the worst sell-off, they were around 96 cents, so 1 ringgit. And today they are around 4 ringgit a share. So mathematic-wise, they are already up by 400+%. So it's already a huge jump. But for those who have managed to bought the company when it was below 1 ringgit, massive capital gains for you. But I think for most of us who are not invested in this company, the more general questions is that does this company can still continue to grow or not? At today's price, is it still a business that shareholders or retail investors want to invest in or not? So that will be a key question that we'll be answering today. But that one is based on each of our cup of tea. Some people may like the company, some people may not like it, but we will share with you guys the business model, and hopefully you guys can make up your mind.
I think we can start now.
Okay, here we go. JFTech, one of the most highly sought after companies. We are doing it today. So before we start, if you guys have not checked out our Facebook, YouTube, and Instagram, do check it out. Give us a like, give us a follow, give us a subscribe. It would definitely help us out. It gives us motivation to continue doing these kind of things and sharing with you guys. We don't touch you guys' money for being our followers or subscribers. It's just purely good, honest sharing with you guys every Thursday. And sometimes we write articles as well. And if you subscribe to our newsletter, we also will share with you guys a free Excel template to help you keep track, calculate your investment returns. So it includes your capital gains, it includes your dividends. You can also put in your brokerage fee, so you know net, even after you put in your brokerage fee, are you actually winning the investing game? Are you actually capturing capital gains and also dividend gains on top of the paper losses, on top of the brokerage as well? So shoot us your email and it will be shared to you free with no additional cost. So here we go. As always, the disclaimer, this is just purely a sharing with you guys. Does not constitute to any buy or sell decision. But if you really like the company, do your due diligence, and even if you earn money, it's not because of KayaPlus. KayaPlus just is here to do a very honest sharing with you guys only. So that's it. Let's go. So this is also one of the companies when we started to study, right? Straight away, we are being showed words that we don't understand. We are being showed pictures that we don't understand. And it really does makes us very confused. But I get your thoughts first, Junpei. When you started study JFTech, what is your first impression when they say, okay, this is what I produce?
I think this is the company that you need to really put in efforts to understand what is the thing that they are producing and how they can actually make money. To be honest, it can be quite difficult if you try to understand what is the thing that they do by reading their annual reports or even look at their official website. It's kind of limited, and only for those who are in this industry maybe can understand that. For outsider like us, I think it's kind of difficult. But nevertheless, we have sort of went through the tough period, try to get what is really that they are doing, and this is the thing that we're going to share. So you see the thing that's highlighted in blue. This is the key thing that they do. Everything they did is about this test contacting solution, meaning they are producing device like what we show in the picture here to act as a contacting tools to help the things in semiconductor industry to do their testing. So maybe in layman term, how you should see it is every time you produce a product, you wanted to test it. Because it's so small, for you to actually test it, it can be quite challenging, and then it cannot be a one-size-fits-all kind of products. So it need to be somewhat customized and whatnot. And this is where JFTech come in. They have different solutions tailored to different size. So you can see it actually broken down by 0.5 mm, 1 mm, or 2 mm, something like this, so that they can contact with the other test sockets, so to test it out whether this product works. And that's it. So it only have the value during the testing phase, and then once they tested the product is certified, then they can roll out, and then they won't need that anymore. But of course, because it's so unique, and then it's not something that they can be reused. This is the reason why their profit margin tend to be higher. It's a customized solution, one of or multiple iteration, but it won't be something that you build and it will churn you the money forever and ever. So the different. And then what makes them so special is they are actually having a few patents are registered under their products, which is, I think, in the whole world only a few companies are doing them, and then they are owning quite a bit of IP belong to them. So this is how they can actually survive in this industry.
Okay, so it's a patented product that helps people to check their chips or their package. So mainly, I think chips or semiconductors are being widely used in a lot of applications. Just now they are in the they are in the 5G, in the radio frequency, and over here they also produce testing solutions for the automotive industries. So our cars also, it's also made out of a lot of semiconductors as well, and it will be having more and more semiconductors as we slowly move into Internet of Things, self-driving cars, the more we tend to rely on AI, on the smart stuff that we are going to use, then the more semiconductors is going to play the role of making our devices smart. So I think we have here is the components or the test solutions that is particularly for the automotive industries as well. Maybe different cars also use different kind of chips. So to test a BMW chip, maybe it's just one socket, and to test chips for another car, say for example Mercedes-Benz, because the chips are different, so you have to come up with another test solution. And this is probably how JFTech makes money. They customize the test sockets according to the chip design or the package design. So yeah. So maybe Chun-Beng, you want to bring the readers through what is cantilever style sockets and how does a test socket play a part in testing finished packaged products.
So cantilever is typically, you can see it is usually put it when you have the L shape kind of thing, and then it's a small piece of thing that contact as in that act as the contact surface between the chips and the test equipments. So you can imagine this thing is so small, but for you to actually test the entire full cycles, you need the thing to be precise, and then this is like the only thing that can prove to the production line that yes, this is the scale, this is the level of accuracy you should go with, then do mass production. So hence why although it's sort of one-off use, but then it must go through multiple iterations within the same products. So it's not like this JFTech produce one product and then sell 2-3 pieces then gone. No, like it will be more than that. It's just the problem will be it's only effective during the testing phase, and then production onwards is nothing to do with them anymore. So this is what they actually have. If you go to the next slide, right?
So I think the next slide will be the more how you see test sockets come together, the relationship between your automated testing equipment and your chips or your packaged product. So you can see here, companies like Vitrox, for example. So they say previously we talked about Vitrox, that they produce ATE, automated testing machine, but Vitrox only produce the machines that will help OSAT companies or other companies run tests. And your chips come in different size. So it's just like, take for example, it's just like your socket. In Malaysia, you always use 3-pin socket. So so no matter where you go in Malaysia, be it Ipoh, be it KL, be it Malacca, to charge your phone, you always use the 3-pin socket because it's standardized in Malaysia. But when you go to Thailand, for example, it's a different story already because Thailand uses a different socket compared to Malaysia. So we need to have a certain socket or a converter to ensure that your Malaysia power brick goes through the iterated power plug charger, then only you can connect to the power socket in Thailand. So it's the connecting piece that actually connects your chip all the way to your automated testing equipment. Then only your automated testing equipment can provide the so-called electrical current or voltage and then run to see whether your chips are effective or not. So your ATE companies will not make you the test socket. They basically just sell the machine. Then it's up to the person or the company who actually buys the machine to find a supplier or help me connect my chip to the ATE machine so that I can run a test. So this is where companies like JFTech comes up and say, okay, I have the solutions. I can help you make the test socket. So I give you the test socket, and you put your integrated circuit into it, and then you connect it to your ATE machine, and you can run your test. And from there, you can prove that your chips are running well, there's no defects, and you can safely and happily ship it off to your customers without expecting any complaint. So small but very important part in the end stream semiconductor business. So this is also one of the things that actually made us very confused. Got 80 already now, how come still need test socket companies? Then once we dig deeper, I said, oh, okay. There is a company that actually plays another end value stream to the semiconductor end stream cycle. So yeah, I think Chun Beng, semiconductor is going to be more and more inherent in our lives as we tend to make smarter or go after the higher speeds in terms of data transmission and also data size as well. So this is the so-called sectors or segments that will definitely use a lot of semiconductor in the applications. So 5G, automotive, precision analog, high power, and also power module. So that's why probably JFTech has been rallying ever since April until now, from 1 ringgit all the way up to 4 ringgit. So yeah, Chun Beng, what are the components or subsidiaries under JFTech Berhad?
I think I think a little bit of history. JFTech didn't start off straight away go into this lucrative business. They started off as the OEM. I think OEM in layman term is you get something, as in you're producing the basic of the thing, and then people will white label, as in put the brand on top of the white label, and then they sell it. So you're like the back-end factory producing a lot of product for them. But the problem with this is you get a piece of paper with some design, you do mass production. So the margin will be kind of low because you're just a manufacturers. So JFTech moved up the value chain from OEM go to ODM. So they start to get them involved in doing the design work, and then eventually they go into the industry that they are familiar with, which is the test contact part of thing. And then from that time onward, they managed to get a few IP along the way. They are still growing the intellectual property that they have, or the pattern that they are getting it from different countries. So this is how they set them up into where they are right now. So, but in terms of corporate structure, nothing much. This is the history of what they have been doing, and then eventually they do expansion. It's just different business pillar go under different Sendirian Berhad. And then, of course, Technology Berhad is the investing arm that they hold all these companies.
Okay. But yeah, maybe from my side, I just can see that straight away. A lot of Sendirian Berhad. So Malaysia-based subsidiaries. But over here, you can see JFH Technologies Kunshan Co. Limited. So suddenly pop up, oh, this is a China-based company. So from here, you automatically look, okay, JFTech Malaysia listed company, sure will have some business in Malaysia. But you also have a Chinese subsidiary here, so based in China. So straight away, it does give me a prompt that this company also does do business in China. So let's see later whether that makes sense or not. So yeah, you can see the numbers never lie. China, I think, is one of the big contributor in their 2020 fiscal year, and it grew actually by 50% from 6 million back in 2019. It grew up to 9 million. Later we will tell you why, or we will show you why why China business can grow until so fast. Other parts of it, it's quite healthy. Malaysia, yeah, a bit correction downwards, but United States also picking up. Taiwan also came down a bit, but Philippines and also the other parts of the world is actually showing a bit of growth. So overall, 2019 to 2020, it grew by 3 million, but the major chunk of it actually coming from China. So wow, it's a company in Malaysia, but with a very huge expansion or exposure in China. So major customer, you can see right here, it will tend to prompt you questions. So customer A is one of the big customer. The volume came down a bit, but customer B, something actually happened. This customer actually bought in 2019, and in 2020 they stopped buying. So question mark, and they never divulge its who. So yeah, we never know. But from here you can see that actually from customer A's kind of procurement patterns, you can see that it's not like a capex. This company does not help other semicon companies do capex like your myKayaplus or your JFTech. So once the company buying from JFTech or myKayaplus, once they finish buying, that's it. Maybe another 2-3 years when the client wants to expand, then only they will find back these companies for buying machineries. But this is like a more OPEX kind of expansion or expenditure for these customers. So they will continue to buy if they have new chips to test as well. But so far, Juming, no idea who A and B is, right?
No. But it's not really significant. If you see the entire result, it's about 23 mil back in 2019. And then 2020 is actually 28 mil. So it's not really significant. So nothing much you should be worried about. But the slide that we are showing right now is something that you should really take we should draw some attention from you. So something that happens when they are going aggressively into these businesses. A company called John's Tech International Corp, or usually they put a short form, call it as JTI, file a patent infringement complaints towards JFTech and claim they have copied their products, which is the one that we show on the left, called Sigma, and then they filed in during 2014, and then they are, I think, multiple iterations, and eventually JFTech make some provision of damages back to them. So back in 2019, they actually made about 6 million plus kind of one-time punishment or penalty to this company in the US. So something to take note, if you have been following us paying attention, you can see actually Sigma is one of the patented product that JFTech has. And they still has, but the patent is not applicable for the US market, because the US market, this thing has been pulled out because of all this court case. So Sigma patent is only applicable for, let's say, Malaysia, China, and so on. And they are no longer selling this product in US market anymore. So, which means this kind of thing, for me, the industry is kind of small. When we zoom down, there is about 5 to 6 companies that is doing this and then making some money from it. Usually it won't run that far, as in not really copying each other, but then it will be some kind of similarity among them. So it's quite easy to fall into these kind of things. And it did happen, and it really caused a huge impact in their income statement back in 2018 or 2019. But then you just need to think of it, it bound to happen in the future, because it's like you have iPhone, then you have Samsung, then you have Huawei, same things. I mean, somewhere around the line that people can sort of copy each other from the looks and the functions. But I don't have much to comment. I'm just saying this has been happen, which is a good thing, because they suffer from the damage and they managed to recover stronger. Of course, for me, if I'm the owner, I will pay a lot more to my lawyer to make sure all these things not going to happen again.
Yep. Very true. So previously we talked about quite a few companies which are also having IP, but we also never come across the one that actually, kena the IP trap, and then it went to court case, and at the end of the day, the company has to actually cough out a sum of money to settle the infringement. But today we already have a real case scenario, a real company that actually got trapped into the IP laws or IP court cases with another competitor company. And you can see here the impact is very huge. Prior to that, you see this company from 2013, 2014, 2015, the profit margin has been going up, the revenue, everything has been climbing up. Come to 2016, a little bit correction, but the overall revenue is still growing one. And 2017 is another good year for them. But we come to 2018, revenue also went higher. But because of the recognition of the one-off sum that they need to cough up because of the court cases, the profit straight away gets slashed 6 million plus. So 6.4 million gets slashed another 6 million. So you only left out with what, 300,000 K only. A huge amount of it actually contributed to the reduced profits. But I think they learned from the mistakes, and then 2019, the profit margin went back to slightly normal levels, and 2020 was actually the key year that actually made the company grew leaps and bounds level. You can see that the revenue actually hit 26.8 million, and the net profit is actually 8 million, and the profit margin is at 30%. So very, very fantastic. But let us find out why. We managed to find a reason. So there's a very robust demand for the test contacting solutions. So they made for automotive application. They also made it for radio frequency or 5G, for mobile phones, and also the Internet of Things, which is 37%. And the rest of it is 26%. So the better profit margin is due to higher revenue, and because higher revenue, usually they manage to spread out the overheads and expenses more efficiently. So you have a lower operating expense. And back then, there was also a favorable USD to ringgit foreign exchange. So all of this actually made everything align smoothly and very nicely. And JFTech managed to report their historical high kind of net profit margin, which is 30%. So, of course, just yesterday, the company actually reported their Q1 2021 results, and actually it was better. So the profit margin you can see here is at 43.8%. So everything improved. Revenue improved even more compared to the preceding quarter. 8.1 million, they book additional 1 million extra, and the profit also jumped 1 million extra. So the profit margin actually stood up 43.8%. And even though it was during a very tough pandemic period where most companies out there, like your banks, like your F&B companies, who are actually affected by the pandemic, this company actually grew their sales. So they did mention that during MCO period, they actually shut down their plant for 2 weeks, but after that, they got the necessary permission to actually run back their factory and actually outperform their sales even before the pandemic as well. So kudos to them. It's a recession, pandemic-proof and recession-proof currently. So yeah, but what about dividends, JuBeng? When you look at the dividend chart trends, is this company a dividend company or more towards a growth company?
I think it's quite straightforward. It's kind of low, but they are kind enough to share some of the profit back to the shareholder. I think you should be grateful for growth company like this. Typically, they don't have the dividend policy, but they still paid out. I think all this is not a bad thing. In small, but I think it's sweet for this kind of company. Yeah.
So after going through their business model, how they make money, the next would be actually to see how they run their company. Does the company grow aggressively in terms of their capex? Does the company do it with a lot of debt? How much cash that the company actually has on hand? So over here you can see that company has been, I think they have already reached a certain size. That's why you see their total assets it's hovering around 41, 44 million, 45 million. It doesn't see, you don't see a huge jump. But the company actually is going through a little bit of a cash raising exercise. They need to raise money so that they can grow. So it has already reached their current maximum, and they are going to set up new factories and buy new lines and actually grow their business. But as of now, you can see for the past 3 years, it's relatively dead. Liabilities, you can see a significant drop from around 13 million down to 6.84 million. So it's due to once they managed to, when business became well, remember in 2020, it was their best year ever, right? So once they got the money, they actually pare down their trades and payables. So they owe their suppliers money, but since it was a very good year for them, they actually paid out almost 50% more of their liabilities, their payables. So you can see that's why, because of that, the liabilities actually went down a lot. And the liabilities is not in the means of debt as well, because this company, it's not very high in debt, around 2 million kind of long-term and short-term debt, and it hovers around 1.8, 1.94. So this company will not be a company that will run into difficulties when it comes to paying back, because they don't owe the bank a lot of money. And your cash on hand is roughly around 14 million. So straight away, easily, they can actually pay off all their debt with the cash they have on hand. Yeah, so going to the cash flow statement, as you can see, 2019 was also the year they pay off a lot of their payables. That's why your blue bar is missing from that. So you earn money from a business, but then you have to pay it off. So operating cash flow got depressed, got reduced. But after you pay off all the supplies that you need to pay and the amount doesn't increase, 2020, the cash flow, operating cash flow increases back again. And basically, other than that, investing and financing is pretty much stable. There's no huge gyration or whatsoever. But as of 2020, because after 1 year of paying off all their payables, the company returned back to free cash flow level. So I think this is one of the key important information that you need to know about JFTech, because they are undergoing capital raising exercises. They are going to do it via private placement. So yeah, maybe just take us through what will JFTech be doing with the money that they are raising.
I think that the key information that we wanted to bring out is, rather than all this, I mean, they did a private placement at the price of, I think, 3 somethings at some discounted rate for them to do all this expansion. As usual, a lot of it go into the R&D and expansion of capacity, and some of it go into working capital. I think all this, it looked all right to us. The key question is, I think Japan shared the cash flow, all those things. They have the money in a way, not like they are lack of cash, but then they still do this kind of private placement. I believe this attract us to go and find out how they did it, who is the one behind to buy it, and we're trying to guess what is the intention. So first thing that we found out is this private placement didn't come from the owner themselves, but to some other parties. But of course, they didn't disclose because it's a private placement. Secondly is from this thing, you can only draw a few conclusions. First is there must be a reason why the people are so interested in it, because back in March they are just trading about less than $1. Now they go into $3 to $4, and people are willing to pay for it privately, and then of course they are the one that is kind of bullish about these stocks. But on the other hand is you are actually having a risk that, let's say they are buying at the price of 3.70 ringgit per share, for example, maybe this is the resistance that you should always go and see. If this thing, no one wanted to lose money lah. So if something go beyond this line, other thing you should always take note, because the one who is putting in money for this are definitely expecting more lah. So, but if it can continue to stay above these figures, then maybe they are relatively safe because they are kind of confident in the next few quarters. I tend to see it from this way. I think a lot of people are positive with it. But we are trying to guess who is the party, but unfortunately we cannot find out.
So yeah, I think this is also one of the things that actually make me very confused also lah. Because you see, this company is not a company that has a lot of debt. Just now we show you guys, right? So this company, averagely maximum, they have around 2 million of debt, and cash on hand 14 million. Total assets around 40 plus million. So that the company can actually go and borrow money and build factory, which a lot of listed companies out there are doing, right? And borrow money for huge companies to do capex. I would say the interest rate for their capex would run around 4% to 6%, depending on how good they are with their banks and how strong they can justify their capex case. But this company actually didn't go to the bank and borrow money. They come to shareholders. Not to say, as a shareholder, I don't like companies to come after me for money. It's a case-to-case situation. Say, for example, if a REIT want to do expansion, right? Usually they max out their leverage, they max out their gearing, and if they continue to borrow, then they will break the regulation, which is maximum 40% or 45%, depending on which country or REITs that you are investing in. So when they hit that threshold, they hit that limit, or normal companies, when they actually hit close to 50%, they want to play it safe. They come for shareholders to ask money. Fine, that one I can understand. But this company, yeah, I'll be like, how come you're not asking the bank first, and you come straight to the shareholders? And if the private placement does not go to the retail investors, your shareholding option percentage will get diluted, because someone else is going to buy the shares. Is going to get diluted by 10%. And if you are not the private placement target, straight away your holding, your EPS will get diluted if the company does not grow. So this is a thing that you need to take note. Private placement usually will not be too beneficial for retail investors. Unless it's a rights issue, straight on, retail investor can participate. Then, yeah, I'm more happy with that. But this one, private placement, and we didn't manage to find out who they placed the shares to. So you can see here in the latest Q1 2021 quarter report, they actually raised up to 2 tranches, right? So the first tranche is at 3 ringgit 20 cents issue price, which listed at early September. So the number of share placed is like it, and the total proceeds that they collected is this much. Then come again, just 1 week ago, there is another 5 million units of shares issued at 3 ringgit 73 cents, and they managed to get another 20 million out of it. So overall, during these 2 tranches of private placement, your shares get diluted by 10%. I think the total outstanding shares is around 2 billion plus. So 2.21 billion. So this is another 21 million into it. So 10% diluted. And the company managed to get this 70 million for their capex purposes. On top of that, not yet finished story. After private placement diluting the outstanding shares additional 10%, the company is actually going to give out bonus issues and warrant. For normal retail investors who don't dig deeper, straight away you say, wow, okay, my bonus issue, I got free shares. I also get warrant, and I can sell the warrant, I can sell the bonus issue, and I can straight away get money because free shares for me. But you have to really understand why company do bonus issue and why company give out warrant. It's also a way of asking money from the shareholders. So basically, what bonus issue is during a few weeks ago, where bonus issues and dividends and rights issues were one of the key topic. We actually share what bonus issue actually does. So when your company earn money, your income statement, revenue minus off your OPEX, then minus off your tax, everything, then at the end of it, you have net profit. After your company, each quarter they report the net profit. That profit goes to your retained earnings inside your equity, your shareholders' equity. So basically, company got earn money after payout everything. As a shareholder, you are entitled to a chunk of the profit because you are an owner of the company. But when it comes to bonus issue, the company don't want to pay you back dividend and in terms of the dividend cash portion from the retained earnings. So what they do is they give you free shares. The cash stays with the company, and then the retained earnings actually get flipped to the shareholders' capital. So in a way, you're automatically investing your cash for more shares. So that's called a bonus issue. And from here, you can see that the company want to actually hold on to the cash that it has generated from their business by giving out current investors more shares. So in the terms of bonus issues. And then they do warrants. So what is warrant? Warrant is actually a kind of derivative that the company pays out. And if you are actually interested to convert that warrant into a normal share, you have to pay the company a certain amount of money. So there will be a conversion price plus the warrant price that you are getting. And then after you pay the conversion price straight away, the warrant gets returned back to the company and you get a mother share as a return. So these are two actions that for normal retail investor, you can say, I get it for free, I can sell it off. But if you really sell it off, you never convert it, your shareholding percentage also gets diluted. So the company is further undergoing or doing capital raising exercises by asking for more money from investors and not going to the bank. So that really puzzles me a bit. But if you do have information or you can find a little bit of justification, let us know in the comment section. Later we will have a healthy discussion. But as of now, this is the so-called information that we managed to find. So company wants to grow, but they are asking the money to grow from shareholders instead of getting it from the bank. So let's go to the key persons behind or running the company. Chuming, you want to take us through?
Yep. So as usual, I mean, every time when we go back to tech-related company, usually the biggest shareholder is the founder themselves, and they are easily owning more than 50%. So for this case, is two of them own more than 50%, so that they can have the veto right to actually determine what is the future direction of it. So all this is kind of positive. Nothing so special about it, but it's just something to let you guys aware of it. This is like a single person owned kind of company lah. So he himself have about 46.5%. He can almost make every single decision.
So I presume the Datin Wang is his wife lah.
Likely lah.
Okay. So yeah, and I think over here you can see that their pay is pretty much in line with the market levels. So if you plan to become a director or whether it's executive or not executive, roughly this is the level that we see lah. Almost all of them are getting around 1 million worth of salary and all the kinds of bonuses and EPF. All the benefits all add together is around 1 million. So nothing too out of the norm. But I think after you look through the company, it's in the semiconductor business or say value added in the semiconductor business, and with a very huge exposure in China. Of course, maybe what are your thoughts in terms of the prospect of a company like JFTech?
Yes, so this is the few things that you guys should take note lah. The biggest gain they get during this pandemic is the 5G and RF is a radio frequency segment of the things, right? Within this segment alone, they make quite a big sum of money, which is something that they managed to grow in a huge leap if compared to last year. And then, of course, they will continue to grow. Secondly, is they will have a new facility deployed target 2021, which is next year. The picture that we use is the current facilities. So the new one won't be this picture, but it's something to expand their production capacities. The third one is something that we wanted to bring it out. If you guys got follow our page or Instagram, I think we posted some update regarding RCEP early this week or end of last week. So basically, this is the formation of world largest free trade zone in terms of the population behind all this country, and also in terms of GDP that all this country populated. So you can see RCEP is basically initiated by ASEAN, which is Malaysia, Singapore, and the remaining 8 countries, together with Australia, New Zealand, Japan, Korea, China, and India initially. But of course, India pulled out for some reason. And then this deal goes on, they decided. Why we say this is one of the prospects, because everyone know who is the giant in semiconductor industry. It's either US or China, and some of you will say it's Taiwan, right? Korea and Japan, I think Japan probably is not so into it, but Korea, yes. Mm-hmm. So it's just imagine US is out of the picture, but the rest is in here. And when we talk about free trade, means it's tax-free. Of course, none of them will get the supply from US anymore. They'll just get from here, whoever they can provide this kind of facility, and it's tax-free. But of course, whether you tax break totally and all those things is within the agreement under this RCEP and to be realized throughout the year. But what we can do is easily Korea and China, they will put their attention into this company if they are sourcing for test socket solution. For example, this is an immediate gain, which means whatever company like the one that won the court case in US won't be a threat anymore, because the only drawback is you might not get a lot of customer from US because of all these court case. But you can see the trend is 2020, China actually giving more business to them. So all this is a positive sign after the realization of this RCEP. And then lastly, it's a strategic expansion partner that they just signed with Huawei recently. Again, it's also China. So it's all these Asia Pacific kind of things that they work together to actually I think this is a famous term. They try to build an airline so that they can actually win the Cold War, the tech Cold War, the technology Cold War. US is one gang and then China is another gang.
So yeah, I think pretty much we just highlighted how important the trade war actually made JFTech one of the winners due to the fact that China companies actually get sanctioned and they have no access to semiconductor supplies, which if it's developed by the US, so China actually are tasked to actually build up their semiconductor technicalities from scratch, and sometimes some things are out of their hand, and that is probably why China companies or China semiconductor companies actually found a way to actually grow, and by having a test socket company like JFTech. So in a way, it's a win-win situation. China continues to do their breakthroughs in terms of semiconductors, and JFTech's business just keeps growing and growing. So, of course, if you want to bank on China to continue fighting with the US in the semiconductor Cold War, of course, the questions that you should ask is like, now we have a new US president. Will Joe Biden continue to become so strict and make China the so-called ultimate evil, and continue Trump's negative perception to the Chinese tech companies? So that one is the question. We don't know yet. Only until Joe Biden enters office or from the speeches he gives, then we roughly will know whether he will continue the sanctions to China-based companies, or will it be less loosened. So if it loosen out, US decides to become a bit more friendly to China, so China will have more options. They can actually buy test sockets from other companies as well. Could be in the US as well. So that could maybe spell a little bit of bearish sentiments to companies like JFTech. So, but as of now, I don't think we see a clear direction on how Joe Biden will want to strategize his relationship with China. But yeah, if you are invested in the company, or if you plan to invest in the company, you have to follow the news and try to make a guess, or maybe time your purchase once things are more clearer. But yeah, this company has been growing. It is a beneficial, one of the key beneficial parties from the trade war. But that doesn't mean that it isn't without risk. So I think we already touched one of it earlier, because they really kena it. They kena the IP court case with one of the US companies, and the US company, I think this one, Johnstack. So that also moves us to the other risk of the companies as well. They are not the only companies doing test sockets, and in fact, there are a lot of companies out there doing. And in Malaysia, you have 2 already. And I think Foundpack Group was also one of the companies requested to be one of the key companies under our Not So Late Night show. We will definitely touch on this company next week. Let's settle your desire and your hunger for these 2 companies, because these 2 companies have been rallying a lot. So now that we roughly know what JFTech does, let's look into Foundpack FP Group next week and see which one is better eventually, and what are the pros and cons of each company. But apart from that, you can see over here, Johnstack, Xterra, and also Coho are the few names that are also competing with JFTech in the test socket industry. So there you go. So I think one of the most interesting parts now is actually the valuation of the company. This is not a cheap company to buy. But let me ask Jun Beng, after going through the business model, the key upsides and the downsides for the company's business, what do you think of this company? Does this business excite you? Would you invest in the company? And what would you be waiting for in terms, if you want to invest, what will make you make your decision?
I think first of all, we should do the max and try to compare the PE to growth. But regardless of how you actually divide it, is still high lah, because the basis is just now it's trading about 95. I think when we were doing some preparation of this company, it's about hundreds. That's why in our titles, I mean in the image that we put in as a cover photo, we put is a lucrative semiconductor company that's trading at 100 plus PE. So
yep.
For me, it's high, but then we should really look at the upside. For me, my personal opinion is trade war will go on. Like it or not, be it Donald Trump's or Joe Biden. Of course, now it's Joe Biden lah. But who knows what Donald Trump will do in the coming 2 months. But essentially, this is the way I see it, because US cannot afford to see another player that can challenge them. They can have a good, as in if they are world top, then the second one, if they are far away, they don't care. But when you are closer to them, especially go into some industry that they are very proud of, and they are making a lot of money from them, then definitely they put all in to actually try to pull them down. It's just the way that they did maybe different. Donald Trump is just very open and the brutal ways, the brutal way, in my opinion. But I don't think there will be a lot of changes even though Joe Biden is in the office. It's just maybe the method difference. So definitely this will go on. The demand will be high. But will this thing continue to grow further? I don't know, to be honest, but in my opinion, it's too expensive now. If there's some near future, because of the people who do the private placement wanted to cash out, then maybe there's a time that we can actually monitor and make a decision whether they wanted to buy or not. But for now, I think it's definitely check up multiple time above. In my opinion, it's too expensive. The biggest trend, in my opinion, is the one who put in private placement. They are the one know when to sell. In my opinion, you will never know. I will never know. And when you realize it's already gone. But the safeguard is they won't sell below 370 lah. I mean, there are two private placement. One is 320, one is 370. Let's say 370 is the level. If you manage to enter this company below that, let's say at 3 or 340, then you're safe lah. You are the same boat with them. Anytime, it depends on when you wanted to cash out. But if you enter now, there is always the risk that go down to 370, for example, because of all this from the private placement. Because if I'm a private placement guy, for whatever reason, they give me the chance to put in this, I would definitely wanted to make money from it lah. And if I'm desperate because of pandemic or whatnot, I need the money, I would need quick money, then I'm the first one who will sell it first. So this is the thing that you need to be careful lah.
Okay, it's a fair point. This is more of on the I would say strategic kind of proposition on the key investors who are buying into the company via the private placement, and also at what price. Since the founders have mentioned that they are not one of the key persons actually buying into the private placement. So yeah, that is one point to take note of. So for those who think the PE ratio is high, let me bring you back a bit just now. The company as of 2020 now, fiscal year 2020, and also the latest quarter one, the total assets is around 44 million, right? And the cash on hand is around 13 million. So if you take 40 plus million and minus off the 13 million cash, so the key assets that they are using to running the factory, the inventories, the PPE, plant and equipment. So that one is roughly around 30 million. So you remember just now they raised private placement around 70 million. So the quantum of that is actually sufficient to actually boost up their output or their revenue by another 100%, right? So because they raised 70 million, then the total assets, plant equipment that they have on hand is 30 million. So 70 million on top of 30 million, they actually can grow another 100%. No, it's 200 because 70 million is 2 times of 30 million. So the company can actually grow at that much quantum. But if you notice their private placement portion, they only commit to grow 25 million of it. So another 25 is parked under working capital. So by when the company wants to go on another expansion phase, we don't know yet, but they are already asking for the cash. So how confident are you in the growth phase or the growth story of the company that the company can straight away grow another time after this round of private placement? So straight away they're already asking for money to grow 200% already. So how fast can that happen? So if that can happen very fast, then your PE will not be expensive, assuming the net profit margin stays the same, which is around 50% as of the latest performance. And you cannot say that semiconductor is not a bullish segment now. It is very bullish. There are a lot of noise. and I foresee semiconductor companies will still get better and better. So the question you want to ask is, how fast can this company grow to justify the PE ratio that it's having today? Do you foresee the company growing that fast so that you're willing to pay tomorrow market open, you are willing to pay 4 ringgit a share to actually get into this company? And don't also forget that they will undergo bonus issue and also issue warrants. That will also dilute your future upcoming earnings per share. So that one you also have to calculate. That one also have an impact on the share price movement. So all of these are questions that you need to ask yourself. No doubt the segment, the current sentiment, trade war is very beneficial to JFTech. But at the end of the day, will you be buying into a company that is well run and growing fast enough that you are happily paying PE ratio of close to 100 as of today's price? I think that is the key question you have to ask yourself. For me, if I'm very bullish on the semiconductor, might as well I buy the top line players who have the controlling power to dictate how fast or how slow human mankind want to progress in terms of semiconductor technology. I can buy to TSMC, I can buy Nvidia, I can buy Qualcomm. These are the players who are actually booming right now at the upstream of the semiconductor phase. Only the downstream players, the OSAT, the ATEs, they are beneficial. So if the top line players die, confirm the downstream players will also die. So that is more of my point of view. Definitely when the whole stream is progressing, doing business well, then everyone has money to earn. But when the business stop, the song or the business actually slow down a bit, then the downstream players are the ones that actually get affected more seriously. That is my opinion. So, but nevertheless, the sentiments currently are very, very good for the companies to grow, just like how you see the company, how fast you want the company to grow, and what will be the earnings per share after the dilution effect takes place. And then you roughly know how high the share price can go. So, yeah, that's about it. I hope you like the company or you like our sharing, and it really helps you to do your study further, or maybe there are other places or other questions that you want to find out more about company, then at least now you have a certain direction to look at. But as for now, we will go to the comment section and see what questions that you guys have. So yeah, TSMC is testing 100 USD now. Yeah, precisely. So TSMC is one of the key chip makers, foundries in the world. I think they have roughly close to 60+% of market share, fabbing the chips for Apple, for Qualcomm, even for Samsung, even for a lot of other chip maker players. And this company has actually grew 100% already for this year. So if I am bullish on semiconductor, and just within the foundry players, I already know TSMC is the best in class. Then if I want to bet on the semiconductor industry, might as well I bet on TSMC rather than the end-stream players, right? So food for thought. So yeah, I think Huawei will actually play a significant role once they actually, become partners with JFTech. As you guys know, Huawei is one of the best or the largest tech companies in China that is not listed, but they are virtually into every key tech areas within the China market. And with their progress in the technical or semiconductor business being impacted by the US sanction, definitely JFTech will stand to benefit a lot since they now choose to come with a joint venture with Huawei. Okay, I think this is one good question, quite fun to actually pick our brains. If you guys could own one company, JFTech, Vitrox, Franken, or Me Technovision, based on your current valuation, which company would you guys pick and why? Maybe I ask you Ming first. Or none of it, and why?
I think in terms of value change, a lot of them are not that bad if you compare to Inari or whatnot, which is in the OSAT areas. And then if you really want me to take a look, I would say Franken is the one that I will pick lah. But of course now it's slightly on the high side, slightly high side lah. But Vitrox for me, it has been reflected in the share price based on their current performance and so on. But good part about Vitrox is they has been able to give consistent result throughout the years. Not for JFTech. JFTech is like roller coaster and is subject to attack by all these IP or patent infringements. And then it's kind of a strategic time for them to actually grow, show the success story because of US-China trade war, all those things. Maybe they already max out their potential in a way. Of course, they can continue to make money, but whether is there any room to grow further that justify the PE ratio, JFTech maybe is not my choice, but I will really take a deeper look in Franken in my own opinions. How about you? Jupan, you are saying something?
Okay. So, okay, good question. I think I would maybe
I think Jupan is gone for some reason. We will wait him to come back. And then we will continue the discussion on this. Feel free to put in if you have any other questions. We will continue to support. And then I think the next question is something on UWC, right? So I think UWC is not really tech company lah, in a way. But if you guys are interested to find out more, we can definitely cover that someday in the future. But for me, they are more manufacturing company, machine kind of thing, not really tech companies. And our team right now to do the stock coverage is more on tech focus or semiconductor. But I will back to the question just now. So that Jupan can
I think when
answer.
you talk about so yeah, maybe instead of one, I would pick two. And why I will pick two, because I foresee these two companies can continue to grow because they have the track record to doing it. And the semiconductor segment bull actually just made their growth faster. If there's no semiconductor bull, these companies will still grow nevertheless, just maybe not as fast as possible only. And these two companies also have very good management on how they run the company. Basically everything is already there. It's just a very good company that I think some other companies should also follow them. So these two companies is Vitrox and also Franken. These two companies we also previously covered for Not So Late Night Show already. But if you guys haven't watched it, please watch it. But I will just briefly tell you why these two companies are so much more unique. Vitrox, if you look into their client breakdown, basically, yes, they serve a lot of clients within the so-called tech segment, but it's not just tech segment. You have mobile players. You also have autonomous driving players. So their clients are very well diverse. And say, for example, after 5G is successfully rolled out, I don't know when, 7 or 8 years, when most part of the world is already 5G competitive or 5G efficiently. Usually for 1G migration, it will take roughly 10 years. Every 10 years, we go up one generation, if my memory serves me well. So after that, how will companies continue to grow when there is no 5G catalyst? So surely the company must continue to grow, only the share price will continue to climb up. So Vitrox as a company, they can continue to look at other aspects to grow, just if 5G growth factor is already played out already. So they also have other factors to look at, other fields to actually continue growing. So the business itself is resilient and not just very dependent on 5G and semiconductor. And for Franken, if you are talking about tagging onto the semiconductor value added stream, Franken as a company, they are offering their services allegedly to TSMC because they have the capability. Not many company can, charge high margin to the world's biggest semiconductor or chip maker. And if they have the capability and they are so proud of it that they even mentioned inside their annual report, not many people can do this kind of service. And because we can do it, hence we are able to charge a high margin, and you can see that their margin has been very stable. They don't need to drop the price because there is a better competitors out there. So basically, they're very good at what they do. There's not much competitor. They manage to get a huge margin from providing the cleaning services to the fabricating companies' equipments. So I would still bet on Vitrox and Franken. Me Technovation is a bit as potential for me, but I think there's too focus on one of their products is too outstanding, and that overshadows the other series within their portfolio to continue growing. So yeah, I hope I answered your question. Basically, for me, I would tend to buy companies that are having a longer growth ahead of them, and not just because right these few years or because of pandemic you have to buy because it's a pandemic beneficiary. And what if no pandemic, then the company stop growing? Cannot be, right? So it has to be a very long term and consistent growth story. So yeah, I think Tantan also has another question.
Hello. Japan got stuck again for some reason. I think back to this question, right? They are more engineering based. Yeah, I think Japan is back.
Okay.
Yeah, I think we do cover this question, then we can wrap it up.
Yep. I think UWC is into the computer CNC. So basically, they use computer controls to actually mold, wheel, and shape all kinds of metal. So, and because they're doing it so precisionally well, it has been also utilized in the semiconductor areas as well. So, and if you manage to get into the semiconductor business supporting role whatsoever, then that's where you show higher margins and fatter margins as well. But their key strength is still within precision making or precision engineering of metalworks. So yeah, I guess that's about it. I think yeah, that's JFTech for you guys. I hope you guys enjoy the company. I hope you guys also keep in mind the upsides and also the downsides. This has to be very clearly realized and understand before you invest in the company, because if the company just fail to grow for whatever reasons, all those capital exercising measures, raising money from public, it will definitely make the share price go down very, very fast. And that wouldn't be a thing that you want to happen if you are a shareholder buying at 4 ringgit a share, these kind of prices. So you have to be very confident only you can buy at 4 ringgit. And of course, if the company can continue to grow, then yeah, 4 ringgit is a fair price. But let's take a look next week at their competitor, FP Group. Also just released their results, I think yesterday or today. And maybe from there, we know roughly whether FP Group is better or JFTech is better, or both also good, or both also companies to stay away.
There's one more question though.
Okay. Evans. From valuation perspective, after factor in company future growth rate, do you think the stock represents stock return of JFTech stock could achieve 30% annually for the next 3 years? Just times the amount of growth in terms of revenue, assuming same profit margin of around 30%, the company can actually give you 30% annually for the next 3 years. Assuming all the stars are aligned again for JFTech, right? If the stars are aligned, yes, that is the potential best case scenario. But you must always know that what if the best case scenario doesn't happen? What if it's just 50-50? What if Joe Biden allow US companies to supply test sockets to China companies, and there will be more competition, so JFTech cannot sell so expensive, so the profit margin goes down, then the profit will not be that much. So your return will not be that much as well, right? So that are questions that we need to ask ourselves. Best case scenarios, yes. If you're asking based on best case scenario, yes, it's possible for 30% annually for the next 3 years.
A few things.
So,
another thing is there new capacity, new plant will be built in 2021. I would say it's a real test for them. Imagine they can fill the capacity within the first year, then probably it's not a problem for them to achieve this kind of thing in the next few years.
Correct.
I mean, of course, it takes time to fill, but from revenue or whatever perspective, it definitely grow.
But yeah, not just to be engrossed by the best case scenario, you need to be, what if just 50-50, and what if worst case scenario? Are you happy with that kind of risk? If yes, then yeah, probably this is a good company for you. But if not, maybe next week we find out on FP Group whether it's the company less risky or is the company in fact more risky than JFTech. But as for that, we leave it for next week. For those in Malaysia, the case has been crazy again, 1,260 cases today. Stay safe and do your necessary measures and whatsoever. Stay alive. We see you next week for the competitor of JFTech, FP Group. But as for now, take care, good night, have a great evening, and happy weekend.
Bye-bye.
Bye-bye.